What has been happening recently in all the interest rate markets is that there's clear evidence, both in the United States and in other countries, that the ability of the government to hold interest rates down is weakening. And perhaps one of the most interesting examples of that is in the SOFR market. SOFR stands for Secured Overnight Financing Rate and is the biggest market in the world in terms of interest rates. By the way, all of the derivatives, including SOFR, have a value of close to $1 quadrillion, and by definition, half of that is always people who want the contract to go up, and the other half is the people who want the contract to go down. So if you're long or short, that's what's going on. And in the case of SOFR, in the last couple months, we've seen very interesting chart action. And first, there was a major, I believe it was in April, surge to push interest rates down that lasted for like 3 or 4 days, and it was big, and then it reversed. In other words, interest rates started going back up, and then about 3 weeks ago, we had a similar, although smaller situation. I believe at that point, the change in interest rates when there was a sharp decrease was like 30 basis points, going from 4.5% to 4.2%. And then more recently, just last week, we had a third of these phenomenon where in both last week and 3 weeks ago, the SOFR price action looked like it was going to start into another bear leg, which could mean that SOFR interest rates, which are, short term, could go from 4.5 to 5 or 6 or 7, which was certainly the case back in the 1980s. Each time, in the last 2 most recent occasions, we've had a sharp upsurge in SOFR prices, but each time it gets weaker, and I think that the odds are very high that what's going on is the ability of the government, or those who want to, in this case, suppress interest rates, is getting dramatically weaker. And I think a number of the reasons we've talked about in the newsletter, probably the most important in the United States, is that inflation is still high. Maybe a secondary comment would be that if you look at what the government says is the rate of inflation, which is close to 3%, and compare that with what the inflation rate would be if it were calculated the same way exactly as in the 1980s, which is to say include food prices and include fuel prices, the inflation rate would be much, much higher, maybe 8-9%. And I have a feeling that part of the reason that the government's ability to suppress interest rates is that people have less and less confidence in the government statistics. And so all of that has been happening, and as a result, I continue to feel that one of the best areas to speculate in is to assume that interest rates, not only in the United States, but also in Japan, will be going up. And so in the case of Japan, that means being short the 10-year Japanese interest rate future, the JGB, and in the United States, along with the SOFR, or buying, or more importantly, in the SOFR contract. Along with that, why we think that the 30-year Treasury bond contract is also a good sign. And I think that in another video, I will talk about why there's a good connection between the weakness in the ability to suppress interest rates and the potential increase in the prices of such things as money, which more and more I think will be considered not paper, but gold and silver.